Hi Digital Chiefs. Today I'm going to answer the question around what the difference is between a VC, an angel investor, an accelerator, an incubator, and a lab. A lot of these terms are super confusing. I know there's a lot of debate between a couple of these terms. I'm going to really look at the general understanding around the differences between each of these, how easy it is to raise capital from each one of them, the differences when it comes to the location as well, whether certain regions it's easier to raise certain kinds of capital. I'm going to really start off with labs. Sometimes these are called studios depending on the region. Labs are also frequently referred to incubators as well. So a lab will help you build the product itself. They might have technical talent that actually helps you to build the actual prototype, the MVP, for example, charge you equity or charge you a fee for it. You might still need to actually apply for this particular program. Think of it as a marketing studio to a point. Marketing studios will perhaps offer marketing services instead of technical development services. That will tend to mean that they're involved in actually helping you build something. The same with the lab. Labs will tend to be used quite frequently with corporate groups that have their own lab. Think of it as a research and development lab. When you see lab, when you see studio, more than likely they'll be helping you to build the product. In terms of fundraising, not charge you the build at all and actually take equity for the build. I've seen a range of deals be set up from as little as 5% all the way up to 80%, which is quite a significant amount. I think it just depends on if you're a solo founder, how much technical development you need and the cost involved for them to actually build the product, as well as the risk of you actually not launching the product as well. It might be a marketing studio, it might not actually be a technical studio. Studios will tend to mean that you will need to be based there, but more and more so now across Southeast Asia, I'm seeing labs and studios start up without really needing you to be physically there. They might need you there for only 3 months. A little bit different where you don't go to them to pitch to fundraise specifically, but they do, I suppose, offer capital in the form of services. Really looking at studios and labs when you're at MVP stage. You haven't got a prototype, you've built basically nothing, you've got an idea. Tend to be really easy to get into. There might still be an application process for it, particularly if they're a great lab and they've built successful products and services before. You might actually need to go in and actually deliver a really compelling pitch to have them as a partner, all the way through to really early ones who might actually just be starting out and therefore a lot more negotiable in terms of what they're willing to give in terms of support. So next up we have incubators. Incubators tend to be just a co-working space. They'll have a co-working space, they'll call it an incubator. They might run a accelerator program there. They'll have established mentors, they'll have some sort of programming, i.e. some access to content, some access to coaching, and so they will tend to put this into a incubator package. Normally you would just pay for the particular co-working space itself. You don't normally pay for access to these additional services. Usually there's no equity involved as well. Might actually have 20 to 50K as we invest. They will tend to sort of cross over to what the description would be for an accelerator. But generally speaking, there's sort of access to space, access to events in the space, access to the network in that space as well. I was a part of the New York City, Brooklyn Media Lab. I had a co-working space there. I had access to monthly mentorship, connections there, events there as well, and I simply paid a reduced rate actually of desk space. These are sort of things that are usually on offer for an incubator. The programming itself might be an additional thing, but it's usually quite flexible. You don't actually have to attend all the events. You don't actually have to attend much of the programming. So given that you'll be accessing the space, paying for the space, you'll be based in that location. If it's a very well-known incubator, it probably has had several exits, several successful companies already spun out. The goal of them is to actually graduate companies so that they either take up more space or really get proper office space. Incubators will tend to be a little bit easy to get in. Many universities will have them. That's probably a good location for you to start working and looking at. Next up, we have accelerators. Accelerators are quite popular. Most of you would know probably the best ones, at least ranked globally, very well known. They are not sector specific. They will take companies that have potential in a range of sectors. Then you've got ones that are a little bit more specific to a particular industry, like fintech or sports tech or prop tech. Similar to the incubators, might actually be tied to a university or a corporate. That particular corporate might actually be looking to invest in research and development into a particular sector. They'll launch an accelerator program as a way to find companies that are targeting specific problems. More than likely, some of them will be funded by some corporates at least. And so those corporates will tend to dictate some of the themes, the kind of companies and the kind of problems and solutions they're looking to fund. Hopefully, eventually when you graduate, to invest in as well. These will tend to be all full-time. Obviously during the pandemic, a lot of things moved online, but these will tend to be in person, intensive for 3 months, 6 months is the general timeline. There's not that many that are 9 months to 12 months anymore, given that they are supposed to be intensive programming. Stage-wise, typically MVP to what are seed stage or pre-seed stage. Don't normally pitch an idea to an accelerator. Very rarely do you see anything above 500K, and 50K tends to be on the lower end. It tends to be based on what kind of companies and what kind of stage they're hoping to attract. If you're a little later stage, then it tends to be a little bit more money up for grabs. They're meant to be around testing your product with customers, fast tracking a lot of that experimentation and feedback loop. Their goal is to help you get to a stage where you then can raise a larger amount of capital once you graduate. The top tier ones will tend to be quite competitive given the track record, but obviously also the larger amounts that they're investing in. The ones that are probably more sector focused will tend to have less competition, simply because there's just not as many companies in that particular stage they're looking for, or that particular sector they're looking for, or solving the exact problem themes of that program. Sometimes it makes more sense to apply to a larger general one if it's more consumer based, but B2B ones will tend to do better with a corporate venture capital funded accelerator. Now let's look at angel investors. Angel investors are looking to invest their personal capital into startup companies. Sometimes you'll hear angel investor groups being a syndicate. A syndicate is really a pooled amount of money. So basically 5 investors might invest 10,000 each, and that's 50K going towards investment for one startup. 10K is the lower end. Mind you, I've seen angel investors write checks in syndicates of $1,000 all the way through to 100K and above. It does tend to vary. Angel investors, again though, are individuals typically, unless they're part of a syndicate or an angel group. They will tend to be quite focused on the particular sector they've got interest in, the particular network they've got as well, to help personally work with this startup founder. The typical scenario, if it's a syndicate, at least a couple of them are a little bit more hands-on with the founder and the business. This is a really great bonus for the founders if you do find the right kind of investor to be part of your early journey. Average is around 25K to 50K, but you will get the odd investor who goes to 100K to 50K. The super high net worths might even write $1 million check for a later stage round, but that tends to be quite rare. Some angel groups, large angel groups, will be able to actually pull together $1 million quite easily, given the amount of investment that they typically write. 250K to $1 million is the rough range. That doesn't tend to happen the first time you raise from that particular angel group. It tends to be when you come back for them for the second round, third round, where they're actually picking up the capital for a much larger round. The expertise of angels will tend to vary as well, given they're individuals. And so making sure you research the particular investor or angel you're looking to pitch is quite important. When you're going ahead and pitching the group, typically you'll have one or two angel investors who are the lead investors, or look at all the deals and then bring you into the network so that you can pitch. So understanding the appetite and the kind of investments they've made in the past is important. Might not have technical experience, might not have the sector expertise you're looking for, might not have the region that you're hoping to build the business in. Again, it can be a little bit mixed. Look at the track record, look at what they've done, speak to people who raise capital from them if you're trying to figure out if that particular angel group is the right one. But they're usually just really great, friendly environments for you to learn to pitch. They're really fantastic groups of people who genuinely want to help entrepreneurs. I was an early angel investor myself before I started managing venture funds. I sold my company and started investing in startups because I wanted to contribute and pay it forward. Many of these angel investors are the same, very smart, very well connected. They might not have expertise building technology companies, but they might be successful business people. They might have just been really good savers as well. So again, it could just range, and they're investing some of their 401k or superannuation in Australia, we call. I will mention though that angel investors I consider more professionally investing. They're not your friends and family. That might be your very first investment check. They know you and they trust you. They will invest. Angel investors are probably a little bit more sophisticated. They are looking for some sort of return on their investment. They probably don't know you very well. If you are pitching an angel group, you'll typically fill in an application form. You'll need to wait until they have their regular meeting cycles. Sometimes that's every week, sometimes that's every 2 months or every quarter. So again, have a look at their website. If it's not obvious, just email them and ask them how regularly they're pitching and accepting applications. Once you've submitted the application, they will look at the applications and then filter down to 3 to 4 pitches per meeting and then reevaluate. So you'll need to usually go in, pitch for 5 to 10 minutes, answer questions for also 5 to 10 minutes. Then the angels would then go away, discuss, and then give you feedback on the pitch itself, on how you can improve. Basically, you're given a review, you're given feedback, you're given perhaps even more questions to come back and answer, or there's interest to proceed to the next stage, which is due diligence. I'm not going to get into that today. It does rely on a lead investor in that angel group to take the lead and actually drive the investment. It's quite challenging getting a group of individuals to be able to get together and make decisions. So sometimes they can take 3 months, 6 months. I've seen angel groups sometimes take an entire year to actually close a round of 250k, for example. I think that was probably more pandemic related. It could be just the founder itself taking a long time to get information back. You are going to have to go through a process with them to apply, get through the application itself, and then pitch in front of them, get their feedback, and then go through due diligence. All of this is really great practice. You are going to have to learn the process anyway if you are ever going to really build a successful company and hoping to raise multiple rounds of capital. So given it's a group, you might not connect with everyone in the group, but more than likely you'll connect with a couple of them. And again, keep in mind the angel investors are there not getting paid. They're doing it on their own time. Even if certain angel investors you don't quite connect with, it's important to be respectful. Those particular angels will know other investors as well. And I say that because I do frequently hear quite critical things about angel investors. They will vary in terms of, again, expertise, check sizes, interest areas. Do your research and understand the individual or individuals in a particular group. Angel investors will also tend to invest locally. They don't tend to go outside their local area, not even typically out of state. Mind you, some angel groups have really good relationships with other groups outside of their immediate region, and it's an understanding that they share deal flow. Frequently co-invest together, probably more national in the way they look at deals. Obviously a little bit harder to get investment capital for angel investors. It is professional capital because there's a process involved. This would be probably the second hardest when it comes to raising capital. The last group that I'm going to touch on is venture capitalists. Venture capitalists invest professionally, very early stage, all the way through to exit, really IPO, pre-IPO. Most of them though will tend to be sort of Series A to Series B and C. Check sizes are usually around $1 million at least to start with, all the way through to 10, 20, 30 million. Just depends on the thesis of the fund and the sector, the location of where that particular fund is. Total size of their fund will give you a really good indication of the check sizes they write. Have a look at Crunchbase. With venture capital, it is a proper process. They have a due diligence process, they've got a vetting process. Application-wise, there might be an application, there might not be. It might just literally be you sitting down and having a meeting with that analyst, that associate, that partner, managing partner, principal. These tend to be the titles for venture capitalists. And if there's interest, they'll get you to perhaps come in and pitch their team. Similar to an angel group, there might be decisions and discussion, feedback and questions. It could be pitching in person or online. You will be expected to meet in person, if not the second meeting, certainly the third meeting, and certainly before the investment is made. Some investors can come in very quickly. They've got a lead investor, their due diligence paperwork is already done by another investor. The round can be closed very quickly. Say you're going out to get your first lead venture capitalist investor. A lead investor really sets the terms on the round, and then they will tend to be driving how quickly everything works. 3 months if you really know what you're doing, but 6 months to a year is also quite common as well. For those of you raising your first round, expect at least 6 months to do this. Anyone who's super experienced, already have a network, might actually close in 3 to 6 months. Subgroups within that as well. There's venture capitalists who are raising their own fund and they have investors of their own, invest on a return given the expertise of that particular fund and the partners in the fund. And then there's corporate venture capital, which is slightly different. They will tend to have a corporate involved. That corporate will have certain themes, agendas, similar to sort of my explanation of accelerators, and they will be investing capital based on where they see potential to develop their own products, eventually potentially acquire the company. Research and development might be part of the reason why they're investing in your company. It could be a value-added service that you're providing to their existing client base or customer base. Venture capital tends to really just focus on the return, whereas corporate venture capital tends to have the return as well as strategic reason why they're wanting to be involved. VCs are always just going to be the most difficult to raise capital in, given they write the largest checks. They will have very deep networks, very established networks. Knowing the investor you're pitching, knowing that particular partner is going to be really helpful for you to get in front of that particular group and then go through the cycle of pitching and then due diligence. Like individuals, funds will have different focuses, they will have different stages. I'm not going to overly get too involved in the structure of a venture capital fund. That's a completely different video. Leave me a comment if you want more of a breakdown and explanation of venture capital funds. I'll reprioritize that video if there's enough interest in that particular topic. It's quite well known that venture capital funds don't have a lot of diversity, certainly not at the partner level. So keep that in mind. Look at the previous investments they've made. Look at those on their team. Is there diversity there? If there isn't, then it tends to be a bit of a red flag that they might not actually be that super friendly with the particular product, with a particular team makeup. They've only invested in a certain location and you're not based in that location. If they've only done consumer products and you're a B2B business. In addition to venture capital, there's also private equity funding. These private equity groups don't always look at just technology businesses. They look at businesses on the whole, very large check sizes, at least $1 million, if not 10 million upwards. If you're super early, private equity is probably not the right setup for you. There are also family offices. Family offices are really wealthy families. It might be an investment manager. It could actually just be one of the family members managing the wealth. Similar to venture capitalists, they will tend to have a process involved. There's somewhere in between an angel investor and venture capital, given that it is private personal money. So hopefully that's been helpful for you. A much longer video than I normally do, but given the amount of differences between all these groups, it's quite important to go through a little bit more of the detail. Did my description quite fit with yours? There's so many variations, and the use of a lot of these terms can be somewhat interchangeable. If this has been helpful, give me a thumbs up. Share this video to other startup entrepreneurs who probably are quite confused about all the different stages of funding and the different groups. Some groups might run multiple things.